Welcome, everyone, and thank you for tuning in today. My name is Megan, and I am the Marketing Associate at RSF. I'm joined by my colleagues, John Bloom, Vice President of Organizational Culture, and Amy Bird, Social Enterprise Lending Manager. This is the second webinar we've hosted on this topic of how we think about and how we set price, and we're really excited to continue this conversation today. John, Amy, and I all work closely together with a few other staff members to design the community pricing gatherings, and we'll be sharing our thoughts about this process with you. So, to give you a little background on the purpose of this webinar, our mission statement is to create financial relationships that are direct, transparent, personal, and focused on long-term social, economic, and ecological benefit. This leads us to ask hard questions such as what is interest and why and how do we charge it. John will be talking more about the origin of our community pricing gatherings, but I want to start by mentioning that what we're discussing with you today is a reflection of our purpose statement and our deep interest in inquiry. So I'd like to launch a poll quickly so we can see who all is on the call. Alrighty, so please choose one of the following that best describes you. I'll take about 20 seconds to let everyone vote. So we have about 26 or 27 people viewing right now, and it looks like the majority of people, about 45%, are financial professionals. We have a number of RSF clients, about 20%, and then we have about another 20% of people that are just curious about RSF's pricing model, and then other people that are just generally interested. All right. So whatever your current relationship is with RSF, we appreciate your interest and hope you'll feel inspired to participate further after this webinar. So to give you a bit of info about the flow of this webinar, we'll be doing about 20 minutes of presenting, and then afterwards we'll have a Q&A. So John will start by speaking about the origins of our community pricing gatherings and how they've evolved. Amy will cover more on the specifics of RSF Prime. And then afterwards, we'd like to have a conversation, as much as this webinar allows, after the presentation. So please feel free to type your questions into the Q&A box at any point during the presentation, and we'll get to as many of those questions as we can at the end. So you'll see the Q&A tool in the control panel on the top left corner of your screen. Make sure that you're using the Q&A tool instead of the chat feature. All right, and so we can get started here. I'm going to hand it off to John now.
Greetings all, and thank you for joining this webinar. I know that Megan had indicated that I would be talking about the community pricing gatherings and their origins, but I also want to address why we're doing them, in addition to just how the model works, why we've chosen to move in that direction, and then something of the nature of the experience itself. Our hope is that if you are an investor or a borrower and are not able to actually physically attend one of our community pricing gatherings, that you, out of this understanding from today, you'd be willing to join one of our virtual pricing meetings, in which we bring together people from dispersed locations who really can't physically gather to also be in the conversation around community pricing. So thank you for taking the time. So Rudolf Steiner Foundation, RSF, that's what that stands for, RSF Social Finance, was inspired by the work of Rudolf Steiner. And as part of that inspiration, we gather monthly to have a bit of a study. And one of those studies, which covers a broad range of writers and thinkers, we focus specifically on Rudolf Steiner's economics lectures, which he gave in 1922. In the midst of that discussion and conversation about those lectures, there was a notion of the nature of price and how that arises, and it's one of the great economic mysteries. And Steiner spoke about the creation of economic associations in which the producers, the consumers, and the distributors would come together to set price such that all parties' needs were met out of that process. That gave us great pause because we set interest rates at RSF, and that interest rate has an effect on our borrowers, it has an effect on our investors, and it certainly affects how we establish our income stream based on that. So we started asking the hard question, so what would this look like if we were to apply the same concept? So the producer, consumer, and distributor together. And for us, that translates in our social investment fund specifically into investors, borrowers, and RSF as the intermediary. I mentioned at the time experience with the community-supported agriculture, where the eaters and the farmers, and in some cases the eaters are also part of the distribution stream, come together, look at the annual budget, and set the price for the share based on the total annual budget, which then says that the prices for that share is set not on food as a commodity, but on what actually is needed to support the farmer for a year. And that really then got us to saying, so what could we do with our own community that would have some sense of that? And the idea of the community pricing gathering was birthed out of that, and said, let's bring our investors and our borrowers and us together to talk about what for prices us is the notion of what interest we would charge. It was a very interesting discussion. It's been a very interesting laboratory experiment. Up until that time, we had been tying our loans first to the 13-week Treasury bill and then to LIBOR. But it was in 2009 when, during the study, we said, let's give it a try. And we left LIBOR as an index and moved to what we called RSF Prime. RSF Prime is the interest rate that includes the interest of the borrowers, the rate charged to the borrowers, the interest to the investors, and RSF's share of the revenue, which I will talk a little bit about later. Little did we know at the time what would later emerge about LIBOR and how much that had been manipulated behind the scenes in the marketplace. It made us look great and prescient for knowing ahead of time what was going on. In reality, all we were really doing is going more deeply into what our roots and our origins are, and the gifts that emerged out of Rudolf Steiner's lectures. So we've had now 29 community pricing gatherings. There have been held in various areas across the country. The face-to-face gatherings tend to be in geographic locations where there's enough density of investors and borrowers to come together to actually have a face-to-face gathering. And in the last year, we've now developed virtual pricing meetings, which are like chat rooms, but visual chat rooms where we can see each other and be in conversation. Those are also going very, very well. So in order to be in the room, it is investors. We occasionally have observers at those meetings if they're interested, or there was a journalist who came with everybody's permission and there was a conversation about that, because they're, as you could imagine, fairly delicate conversations. Talking about money is always a challenge. And then borrowers, and we try to have a number of borrowers in the room, some for-profit, some not-for-profit, because the world looks different in those two worlds from a budgeting standpoint. And they go very straightforwardly. We start with some brief introductions so we know who's in the room. And then quickly we move into asking investors why they're investors, and what drew them to RSF. We spend a little bit of time talking about RSF as an intermediary and what does that mean? What are the particular challenges to an intermediary that actually has a natural interest in everybody's success, rather than, say, a bank which is looking at how much they can earn from that relationship. And then the borrowers, who are asked to speak a little bit about what their work is, because it's also getting to know each other a little bit, and what the loan that they've received from RSF makes possible for them. So that warms the room up, and then we move, after explaining how the whole system works with everyone, we move into the actual pricing conversation by looking at, for example, what does it look like if interest rates were to go up? What would that mean for the investors? What does it mean for the borrowers? And I know Amy will walk us through that in much more detail in a few minutes. But at the end, what we ask is there a sense of the room that's a recommendation then to the RSF Pricing Committee about what should happen with the interest rates for the particular quarter? And we take those meetings very, very seriously. We learn a lot from them. What happens, even in addition to whatever recommendation may come, and I've seen this time and time again, where investors suddenly realize, oh, if I want more interest, that means the borrowers are going to have to pay more. And that puts them into a position of having to make certain financial decisions. And I don't know if I want to put them in that position. And so maybe I don't want to ask for more interest. And we've also heard borrowers who said, I now understand that actually it's your money that has made it possible for me to do this. And if you're depending on the interest that's earned from that, I have enough latitude. It wouldn't be a problem for us to add 1/4% or 0.5% to the interest that we pay. And I really don't know any other context in which a borrower would say in a meeting, I'd be willing to pay more, or an investor that said I'd be willing to take less. That is a natural, which normally speaking, those are in opposition to really see and hear each other's stories and connect the dots, realizing whatever I want actually affects the whole system. In addition to how we earn our spread, that is our revenue share that's earned through the process, so we come to a place of understanding how the whole system works and a shared ownership of that. So this graphic is really meant to give you a sense of, one, the flow of funds, and also how we earn our share of the revenue, because you see from borrowers, they're very busy, they're production in the marketplace, they earn revenue, they pay back their principal and interest from the loan, that comes back to RSF, which then goes back in principal and interest to the investors who earn. And you could extend this little loop further out, because every borrowers are also, probably investors or consumers are having to purchase from their suppliers. Investors are busy working in the world, earning revenue and have savings. So it's a nice flow loop in which we're all a part of. So rather than thinking we get out of the exchange, it's actually the revenue that we earn that supports our day-to-day operations. That's really our share in agreement with our investors and our borrowers. To my mind, that is probably the best working definition of an associative economy, where the investors and the borrowers and us as the intermediary are sitting together to determine how do we meet each other's needs while we're producing value in the world. So investors are earning a little return on their money, feeling really good about the values that are there, and the borrowers have some sense of what their source of capital is and feel connected to that and the people who make that possible. And actually that informs their mission to change the world, whatever that is, whether it's in the food systems or education and the arts or in ecological stewardship. So enough said with that, I think, and I will introduce Amy, who has a deep working knowledge of how the loans actually work in organizations as a lender. So.
All right. Thank you, John, and hello to everybody. So, as John described, RSF is working out of the picture that if we can make the stakeholders in our community more visible to each other, that can really create an environment where the needs of everybody and the whole can be better met. And we find that in these, just the work of organizing and engaging in the community pricing gatherings, it's one of the most tangible ways that we can really ground our purpose statement, our desire to change the way the world works with money, and make that tangible in our day-to-day activities. And so what we're going to do now is look at a slide that kind of help us break down a little bit just what RSF Prime is and how we come to it. So as John was describing, there are some basic components that end up making up RSF Prime and the interest rates that that our borrowers pay, and they start in a way that is not unfamiliar to how other financial intermediaries work. One important element is the actual cost of the capital, the return to the investor. And right now, for RSF investors, that is 0.5%, 50 basis points, comparable to what a bank CD might be. And we have at this time close to 1,600 investors who are earning that return. So then in the next slide, what we see is what happens when you layer in RSF's share of the revenue, which is what makes possible this intermediary role that John described. Just to add a little bit of color to what he was sharing, this is not just what keeps RSF's doors open and the lights on and facilitating transactions. It's really what allows RSF to function fully as a financial intermediary, to really build relationships, take time to know investors and borrowers, do our due diligence work, be patient in work-throughs when borrowers may be having difficulties. It allows us to cover our loan losses ourselves. And we find that, which I want to say are very few, but we find that as a nonprofit doing our own fundraising, that to be earning the majority of our revenue ourselves is very important in terms of a level of autonomy that it provides within the interdependent relationships that we have with borrowers and investors. So then in the next slide, you'll see how with the investor return of 0.5%, and then the RSF revenue share of 4.25%, which is what it is currently, you get to the current level of RSF Prime, 4.75%. And that is what we would call our base rate. And then from there, we may adjust pricing based on impact, on perceived risk, competitive structure, other factors of that sort. So different borrowers, won't all be paying RSF Prime. They will be paying different rates. Many of our nonprofit borrowers will qualify for the lowest price that we can offer. And just to kind of give you an idea, this is something that's changing all the time. But with, as our loan portfolio changes, but RSF's current net interest margin is around 4.45%. So to look a little bit more deeply at what a change to RSF Prime might be made up of, in this example here, you see that if there were a recommendation coming out of a community pricing gathering and then a decision made at RSF to increase the investor return by 0.25%, that if there was no change to our RSF's revenue share, then that 0.25% would be added to that final rate of the base rate of RSF Prime, and it would move to 5%. I want to make very clear that at all community pricing gatherings, RSF's revenue share is on the table and looked at and discussed. So it is something that can potentially change as well. So this is, again, just one example of how a change might change to RSF Prime, but what does that actually mean for an average investor or an average borrower? So here what we can see is although our investors are investing anywhere from $1,000 to $1 million or more, our current average investment size is $60,000. And so over a year, the change of a 0.25% in the interest rate would represent an additional $150 that investor would earn. And in terms of our borrowers, our general range for loans is from around $250,000 to over $5 million, with an average loan size of $700,000. And so that same change in the interest rate from 4.75 to 5%, if it was someone paying RSF Prime, that over a year is $1,750 in addition that they're paying in terms of interest rates. And I think that those numbers highlight a couple of very important relationships that are part of the whole. One is that the impact on a borrower that might have a fixed annual budget, say a school or any kind of organization that is budgeting on an annual basis without much possibility for change in revenues in that particular year. A mid-year rate change may have a significant impact on them, especially if their loan is larger. And so that's something that can come up in a gathering conversation. And I think the other thing that's really important to point out here is just how many investors it takes to make a single loan happen. And that's that's very clear looking at these numbers. What happens through the formation and review of RSF Prime and the community pricing gatherings is that those kinds of relationships that I was highlighting and the impact and the interdependence, they're all explored and made real to participants and then to the community as the process is shared out. And it's really the variety of perspectives and experiences in the world of borrowers and investors as well that makes the gatherings so powerful and enriching. RSF is actively engaged in wanting to expand that community, and we find that our existing clients are really our best referrers. For investors, again, we're looking at $1,000 minimum to open an account. And with borrowers, just to give you some just real general parameters, we're looking for organizations, either for-profit or nonprofit, that are working to create long-term social and ecological change. And typically, we find that we're working with borrowers that have at least 3 years in operations and at least $1 million in annual revenue.
Alrighty, thank you, Amy. This is Megan again. So I'm going to speak briefly about the online community pricing gatherings that we've recently launched that John mentioned earlier on. So for a while now, we've thought about how we can broaden the geographic participation for our community pricing gatherings. We host them in different locations each quarter based on where we have a concentration of borrowers and investors. So you'll see on this map here, this is all of our borrowers that are currently in our portfolio and their locations. And so we currently have about 90. And a map of the investors would be a little more dense since we have about 1,600 investors, but similarly dispersed in these clusters. So because of this, we end up hosting our gatherings in these client-dense regions, such as New York, San Francisco, or Philadelphia. So to address this, we began offering online community pricing gatherings last year to better include folks that live outside of these regions. So we now alternate back and forth between doing these in-person gatherings and online gatherings. Our next online gathering will be in early December. So if you're interested in attending, but maybe you're not a current borrower or investor, you can become one, or you can become an investor, as Amy mentioned, for $1,000. So I hope you'll join us. So that wraps up our presentation portion of the webinar. Now we're going to move into answering some questions from the audience. I'll be reading out questions to Amy and John, and then they'll be answering them. So as a reminder, please type any questions you have into the Q&A box in the top panel, and we'll get to as many as we can. So we'll give a few seconds to let some questions come in. Let's see, we'll start with a question for Amy. The person asks, what you describe as interesting. Doesn't the conversation often just come down to investors advocating for higher returns and borrowers advocating for lower rates?
Great question, thank you. You know, as John was describing earlier, yes, you know, certainly those are perspectives that are brought into the gatherings, but in the gatherings that I've, one that I witnessed about a year ago, and then others that I've heard reports back from, actually it is very often a you know, a borrower who will suggest, you know, say a for-profit borrower, they might be able to pay a higher rate in order for a nonprofit borrower to have a lower rate, or really, you know, again, a borrower who is saying, you know, I think it would make so much sense if we had, if we were able to pay a higher return to investors. That would be a way of attracting more investors or keeping more investors, and overall, we as a whole, as a community, would be able to have greater impact. So it definitely does not just automatically fall down that sort of line of self-interest at all.
Thanks, Amy.
Sure.
This one's for John. The person asks, can you imagine other financial institutions adopting this approach to setting interest?
It's a great question. It's one that we get asked very often, and it's interesting that in the last year or so we've had a number of inquiries from financial institutions saying, how exactly do you do this and what would it look like? Our sense is that community banks and or credit unions that have natural constituency and identifiable sort of geographic boundaries, or places where they can actually say, here are members that we could bring together, could actually engage in a similar kind of conversation. It needs to be set up, and there needs to be openness and transparency across the whole process, which is always an interesting moment for most typical financial institutions. So it's our hope, though, I mean, as part of being a leader in the field of social finance, it's our hope, if the model gets adopted and practiced, I think it would start to change a lot of people's lives.
Thanks, John. Here's a question that's, I'll give this to you, John, also, and it's more specific to our pricing meetings. So do these regional meetings set rates for everyone?
Sure. The meetings themselves result in a recommendation that we bring back to the RSF Pricing Committee. So the meeting, it's not actually setting the price. We really see each of the regional meetings as a kind of standing in for the whole. The issues that are rising up, the macroeconomic issues, the regional economic issues are all quite present there. We're mindful of that, but our task is to bring that back into the broader context of prices generally. But I would say that, you know, the exercise of having the conversation is going to be hugely important if and when interest rates actually rise. Because when interests rise, investors tend to benefit more and borrowers tend to suffer. So we can, as a community, actually be in conversation to bring some balance to that more typical, challenging pattern. And having the pricing meetings now and learning how to see each other and hear each other's needs and live with the shared result that then comes back to us as a recommendation is hugely important.
Thanks, John. Amy, has the RSF revenue changed over time?
Revenue share.
Revenue share changed over time. Sorry.
Yes, John could probably fill in exactly the year that it happened, but there was a recommendation and a decision made that the RSF share of the revenue would rise from 4% to 4.25%. And a real piece of that was a recognition of RSF's role in terms of field building and the intermediary work, and that in order to build capacity and to work, for the kind of change that that John has been describing, that RSF needed that additional share of the revenue to facilitate that change.
Great, thanks, Amy. Actually, another one for you, Amy. How do borrowers feel about signing loan documents without knowing the future interest rate?
Sure, that's a real kind of timely question for us now, especially in a market where we're anticipating potential for increase in interest rates. And so it really depends on a case-by-case basis. Some borrowers understand the adjustable rate. They appreciate that they can participate in these gatherings, that their voice will be heard, and they like the idea of being part of this associative process, and that they can work either through their own reserves to mitigate the risk for them for a change in the interest rate. Other borrowers find that that's very challenging, and so one of the things that we do, for example, with our school borrowers is we set up a way so that they can actually over a year have a fixed payment plan that will then sort of, so that they can count on a year period of making a fixed payment amount. And then at the end of that year, there's an adjustment if there has been any adjustment to the rate. We also are looking at what we might be able to do in terms of the balance of investments and loans to be able to consider instances where we can offer a fixed rate if that's really what's needed.
Thanks, Amy. And this question is sort of similar to what you were just talking about. So it sounds like rate changes don't affect all borrowers equally, i.e. nonprofit versus for-profits. Is this correct?
So the prime rate actually affects everyone. So when the prime rate changes, it'll affect every possible loan. Not everybody is paying the same prime rate. So as Amy mentioned earlier, some of the loans, particularly in the for-profit, are risk adjusted and depends on the nature of the product, because some are working lines of capital, some are accounts receivable inventory financing. So there's a variety of kinds of loans, which means the pricing can be a little bit different. But most not-for-profits are at the prime rate, and we try to get everybody as close to prime as we can. But we also understand that there's a relationship between the interest that we're charging and the amount of work it actually takes to manage the loan well.
Thanks, John. So Amy, do you ever use credit enhancements such as loan loss reserve programs to lower rates?
Not specifically, but I would defer to John if he can think of any examples. In most of the relationships that I'm working with, that's not something that we're doing.
No.
Alrighty, so we'll give this one to John. Are there limitations to how much a rate may change in a given quarter? And is there an ultimate rate range?
So the rate would not change in any given quarter, because once we set that rate, it's for the quarter going forward, and then it's reconsidered again at the next quarter for the next quarter going forward. So if you're to look at an annual basis, of course, there are going to be 4 quarters, and the rate could change. Generally speaking, we have not experienced radical changes at any given time. There's no cap on that. We really, I would say the cap is what our community will agree to. It's not solely up to us. This is why we have the pricing meetings. If the interest rate environment changes drastically overnight, nothing would change here until the next quarter meeting, and we'd have a conversation. And the whole purpose of why we exist is actually to be able to move money to support initiative. It isn't a money-making proposition here. So we would not want to engage in a process that would actually make it impossible for say a social enterprise to make it impossible for them to operate anymore. We'd have to figure out another way, and we can be very creative in how we work with that.
Great, thanks, John. A question for Amy here on the lending side. Do you require guarantees and other securities as conditions of the loan?
In many cases, yes, we have found that having the option of a guarantee can really make a loan possible that might not otherwise be the case, and that, but it's not a requirement in every loan. What we find, though, is that with guarantees, they have a value beyond what you might just call, the actual credit of the loan. The value of a guarantee, especially if it's coming not just from, say, a single person, but from a number of different community members, it provides a kind of a warmth and support around a loan, to know that that all of these different individuals are supportive of that organization and what it's working to accomplish, and that if it ran into any difficulties, that these would be people who would be at the table really working to support finding solutions. So we definitely find that the dynamic of having guarantees as a piece of a credit has numerous benefits.
Thanks, Amy. I'll give this one to John. Do investors generally share Steiner's philosophy? And if so, do you think this community pricing approach would work for a more diverse group of investors?
So I think it's very, very small percentage of our investors that have a connection to Rudolf Steiner's work directly. I think there are many, many people who are asking the hard questions around money and the financial system and want to be more connected to their money and have some say in how it's working, out of a sense of what they really care about and their values. So I would say, generally speaking, that the community pricing approach has been working among a more diverse group of investors, because it's pretty, there are some, but it's certainly not a requirement by any means. It's mostly, does this make sense to you as a way of working in the economy and working with your money in a new way, with the social foundation that we're really trying to build. So there's no prerequisite of philosophy or beliefs or otherwise, except a really wish to participate in the Social Investment Fund with social entrepreneurs and in a new way.
Thanks, John. And this question is about the pricing meetings themselves and how they work. So how does RSF balance participation between borrowers and investors at community pricing gatherings? Should I give that to you, John?
Sure. I would say, we like to have a balance. We like to have at least 50-50, if that's possible, of borrowers and investors. But it's very rare that we would have a meeting, say that there were only 1 or 2 borrowers and 15 or 16 investors, because that gives us a very imbalanced picture. So our goal is to have as many voices present as we can without getting so large that we can't have that kind of intimate conversation. And we work really hard, the lending team works really hard to convince borrowers that it's actually a worthy experience. And most of them have found, while they're very busy getting their work done and don't understand why they would need to come to a meeting, every one of them, I think, has found that it's been quite profound for them to have that kind of relationship to the community that makes that loan possible.
Thanks, John. Let's see here. I'll give this one, I think, back to you, John, or Amy, feel free to chime in. How was RSF's 4.25% revenue share derived? How much is allocated for risk, administration, profit?
Yeah, so if anybody's interested, you can go on our website and our financials are up there. So you could certainly go through our operating budget and see how the money is expended. We earn from the Social Investment Fund approximately 70% of our income. So maybe that is a helpful context. The other 30%, I would say another 15%, so half of that 30%, 15% of that is earned from fees from our philanthropic services programs. And then we raise in gifts about another 15% of our operating budget. So that it gives a picture, and we talk about our operating budget and how the Social Investment Fund contributes to that and the needs for that, as well as what we try to do on a relatively tight budget that is above and beyond just the transactional level, because for us, we sometimes call the cost of transformation is very high. We do that, it's deeply human. But that is really the work that moves us forward into the world. So transactions are really about transforming the culture of how we are with the money. So we don't have a profit because we're actually a not-for-profit. We do have retained earnings. And the one important thing to keep in mind that is part of our revenue share is that if there is a loan loss that is not covered by any of the guarantees or otherwise from the loans, we actually have to write that down, rewrite that down out of our operating budget, and cost is not borne by the borrowers or the investors. That is borne by us. So we do have to reserve against that. We have a whole reserve policy in which we try to keep about 10% in cash reserved against our funds, our overall loan portfolio. And again, that is pretty visible in our financials.
Thanks, John. Amy, we have someone here who is considering investing. How will they know that their money is having an impact?
Great question. Yes. Well, we do a lot of work to share out the stories of what borrowers are doing through the website, through the e-news communications that we send out. And so those are regular ways of hearing the stories from borrowers. I wanted to add too, some of the best things that happen at a community pricing gathering are actually the investors and the borrowers getting to speak with each other and to hear the personal stories there, or find maybe things that they want to work on together. So just by elevating the stories of the work that's being done, there's a pretty steady stream of information about what that impact is of the investment.
Thanks, Amy. John, can you discuss an example of a particularly difficult experience in a pricing meeting? And how do you navigate through those tough moments when you know that your decision will negatively affect someone in the room?
I love that question, and I want to answer, and I also have to, what goes on in those meetings is we call fairly confidential, so I'm going to have to characterize the situation. So even at our last pricing meeting, one of our investors asked, so do you all have issue with the fact that if I have a higher balance as an investor, that I could ask for a higher interest rate because I have a larger piece in the portfolio? And it was asked in such a way that it could have incurred a certain level of wrath, judgmental wrath around that, saying, the folks who have more always seem to get more, and why are you asking for that? I mean, it could have gone that direction. So as the facilitator of that meeting, I certainly held my breath and said, let's just give this a minute to settle. And of course, we did have a response to that. But before we needed to say anything, one of the other investors, also high net worth investor, said, that's not why I signed up to be as part of the Social Investment Fund. That's not why I'm an investor here. I like the fact that we're all in this together. We're all treated, in a sense, equally in that whether it's $1,000 investor or $1 million investor, the interest rate is really the same, because that's why we're here in this conversation. So there's a certain level of trust that is built up in the room, that it is really the community's conversation. It isn't just RSF to sort of answer and respond to everything. We did add a little bit to the texture to that conversation as well, but that was one of those delicate moments. I think that's one that described. I could add several others. We have limited time. There was one moment when there was a older person who has her investment funds here, who depends on the interest income from that, who said, I really depend on the interest income from my investment fund for, daily life. And one of the borrowers just said, I now understand how this whole thing works, and I'm willing to pay more interest. And that's a very beautiful story. But at that very same moment, one of the other borrowers said, but wait a minute, I can't afford to do that. So there was a moment where, a certain feeling came forward, and then someone who didn't necessarily agree with that. So we had to kind of talk through that, and they talked to each other, because again, it's a community pricing meeting, meaning it's actually a group of peers, all of whom have a part in the whole, who have to really meet and see each other. And by the way, those two borrowers ended up talking even more and collaborating on a project together.
Thanks, John. Quick question for you, Amy, about the lending portfolio. What percentage of the loans are with nonprofit organizations versus for-profits?
Right now, it's actually fairly evenly split.
Great, thank you. And this one can go to either of you guys. Do all investors and borrowers meet quarterly? And is this a burden for them?
Yeah, I can respond to that. No, everyone does not meet quarterly. The quarterly gatherings are, as John was saying, we have ones that are regional, where people are meeting face to face, and then we started doing the online meetings. And so out of 1,600 investors and say over 100 different borrower organizations, at any given meeting you might have say a total of 20 to 25 individuals or organizations represented. So that aspect of it, no, it's really an invitation to participate, and not a requirement that I think would be considered a burden.
Great, thank you. Let's see. Give this to John. Do you ever have a time when there's a mismatch with the amount of money investors are putting in and with money that's ready for the borrowers?
Sure. So of course, the beautiful dance in the fund is between the amount of investment funds we have here and the amount that we're able to deploy to the borrowers. Right now, we're fairly close in terms of the amount in and the amount that's going out. Over the last several months, I would say it's been a little bit higher. It does go up and down. The only time we get really nervous is when there's significantly more borrowing demand than we have investors on hand, but then gets us very active in contacting our current investors to see if they'd be willing to add more, to get out to more folks to see if they're willing to open investment funds. Nothing like a real need in the world to motivate people to participate. But right now we have a nice balance. We'd like to keep about 10% available so that we can take advantage of loan opportunities when they come to us. So that probably just give you a picture, but the internal part of that is that we have a little healthy competition between the lending team who wants to get the money out and the investment client engagement team who's talking with investors to kind of see how we can move that money. The most important thing is that we're actually moving the money through and out into the world for social benefit.
Thanks, John. I'll give this next one to Amy, and John, feel free to chime in. Do you measure additional benefits that investors receive through this process beyond interest earnings?
That is a great question. And actually, I'm very familiar with the work that we're doing around social impact for our borrower community. And I'm actually not sure what we do in terms of any kind of like quantitative measurement of the impact on investors. So I will toss that one back to John.
Sure. So we have, over the last 4 or 5 years, done some impact assessment with our investors because we know that our borrowers are out in the world, our social entrepreneurs are out that have a mission and are having impact in the world. But we also know that when someone decides to actually become an investor is an important moment. They've made a conscious decision to write the check, fill out the very simple form online or the paper form. And that is a huge commitment. And we wanted to know, so what actually got you to the point of being ready to write that check? Because it is a moment of transformation. So we have done surveys of our clients. They're not client satisfaction surveys or marketing surveys. They're really a survey that says, how have you been changed by working at RSF? Or if you found us because you were had already done a lot of work on yourself or were changed or knew something needed to be different. So how has that deepened your relationship to money and your understanding of working in the economy with financial resources? So we have some of that data. We have published it. We're fine-tuning that. This is in process. So they're more in the story form than measurement. So we look at it as an assessment form rather than a measurement form.
Thank you, John. We'll give this one to Amy. And just a note here, we'll have time for maybe 1 or 2 more questions. So Amy, are you lending in or accepting investments from countries outside of the US?
Right, great question. So right now, our lending is happening in the US and Canada. That's where we are able to lend. And in terms of investments, we can take investments, I think in 47 of the 50 states right now. And so again, it's primarily US, North America centered, our work.
Thanks, Amy. Let's see, 1 or 2 more here. John, do you tend to get the same people attending pricing meetings, or is there a mixture of participants at each gathering?
It's usually a mixture of participants, partly because we're moving locations. And I don't think we've had any repeats either in the virtual pricing meetings. I will say that there are probably a handful of people who've been to multiple pricing meetings simply because they love them. but because it's new people each time, it's a different kind of conversation, and we do have different borrowers at every meeting. I don't believe we've had very many repeat borrowers as well. So every meeting, pricing gathering that I've facilitated, and I think I've facilitated probably 25 of the 29 or so, has been a different meeting. Even the same people are in a different place when they come together. So yeah, I would say there's always a diversity of views and a range of, let's call it a range of assets and a range of scope of borrowers of different sizes, large and small, as well as not-for-profits.
Thank you, John. And I think that about wraps it up for the Q&A. So that will be the end of our webinar here. Thank you so much for joining us today. If you have any questions about receiving a loan or opening an investment account, please contact our colleagues, Stu or Mark, and their contact info is listed on this page. And also be sure to check out our brand new website, which just launched earlier this month. All right, have a great day. Have a great day. Bye-bye.
Thank you all.
Thank you. Bye-bye.
Bye.